Hey everyone, this is Mr. Harrison. In this video, we're going to talk about an introduction to journalizing transactions. So in the last video, we talked about some of our basic accounts that our business has. We have a cash account, which follows how much money we have. We have an account receivable, which follows how much money is owed to us. We have a supplies account where we track how much we have in supplies. We have an insurance policy account that maybe we track for how much insurance we buy. We have an account that tells us how much someone owes us. We have a few accounts under owner's equity where we have owner capital that tells us how much the business is worth, how much the owner's interest in the business is. Anytime the owner puts money into the business, it's going to go into owner capital. Anytime we make a sale, that effectively increases owner's equity. It increases the worth of the business. So we have a sales account here. Every time we make a sale, we're going to put that amount of money here into the sales account. We're going to track these numbers. Every time we pay an expense, that's going to kind of detract from owner's equity. And then owner drawing will also detract from owner's equity. That's every time an owner takes money out of the business for personal use. So we have some examples here. I promise that each of these examples will account for all of these accounts. Every transaction gets two, am I at the front of the camera there? Two accounts. Every transaction gets two accounts. That means that whenever we have one account being altered, we're also going to have another account being altered. So that brings us to one of the most fundamental accounting hallmarks, and this is something that some people just can't get. I'm not asking us to get it today. I'm not asking us to become accountants today. You're not going to be able to go out and pass the CPA, Certified Public Accountant exam after seeing this video. That's not the point. The point is to give you a brief introduction to debits and credits because it is the way that businesses track their money and use accounting documents that have this terminology. So I have open over here this Excel file. I chose not to use the sheets napkins as I alluded to in the activator. This is an accounting journal. It's pretty basic. All we're going to do here is identify the date that a transaction happens, the account, which is going to be one of these that gets altered, and we're going to put a dollar amount of money, an amount of dollars, into one of these two columns. We have a debit column and a credit column. So what gets debits and what gets credits, you might ask, and that's a fantastic question because that's what we're going to talk about in this video. Okay? I'm going to put over here, I guess I messed it up because I have that equal sign there. Let's put it down here. All assets go up by debit, go down by credit. Okay? We have to keep that in mind. You might have heard of debit cards and credit cards, and you might have these, you might think of like, extra credits. A debit is something bad, a credit is something good. You might have these preconceived notions of these terms for accounting purposes in business bookkeeping, which is what we're doing right now. Throw those preconceived notions out the window. These terms are different right now than they are in anything you've used them before. So, in learning here about debits and credits, all assets go up by debit. We need to just make a mental note of that. Okay? Let's talk about accounts payable. Any liabilities? These go up by credits, go down by debit. So it makes sense. Anything on this side of the equal sign, on the left side of the equal sign, anything goes up by debit, down by credit. If it's on the right side of the equal sign, it goes up by credit, down by debit. So they kind of like balance each other out. So it gets a little bit interesting over here under owner's equity, right? I'm going to make a little bit different notation here. Owner capital increases this side of the equation, so it goes up by credit. It goes up by credit, down by debit. So I can put a credit there. Sales increases owner's equity, therefore it would increase this side of the equal sign in this, equation up here. Sales goes up by credit. Expenses effectively take away from owner's equity. So we mark them in as debits because they kind of work against owner's equity. They bring this number down, if you will. Okay? And owner drawing also brings owner's equity down, so we're going to mark owner drawing in as a debit. Now let's see how this works. Okay? What we're going to do here is we're going to journalize these transactions. So today is, let's say, March 7th, and well, we wouldn't be mowing lawns anymore. Let's say May 7th, okay? We start our business on May 7th, right? I'm going to make these a little bit bigger so it'd be easier to see. The date is May the 7th, okay? Our first transaction is over here. Received cash from the owner as an investment, which is owner capital, for $1,000, okay? So let's see what happened here. We received cash, so cash goes up. Owner capital goes up, the worth of the business goes up because the owner invested $1,000 into it. So we know that cash goes up, it's an asset, so it goes up by debit. The amount is $1,000. So right here in the account title, I'm going to write cash. I'm not going to worry about these little gray accounts right now. Again, that's for an accounting class. This is not that. This is just a little introduction to accounting. So I'm going to put $1,000 here in the debit column for cash. The other one is going to be owner capital. Owner capital goes up by credit. In this case, we are increasing owner capital by $1,000. So what happened in our business? Owner capital went up by $1,000. Cash went up by $1,000. So cash gets a debit of $1,000. Owner capital gets a credit of $1,000. And that will bring us to the other major thing we have to know. Debits must equal credits. All right? In any transaction, in any accounting context, debits must equal credits. From the most simple transaction like these to the most complicated transaction that might take 3 pages to dole out. Debits must equal credits. Okay? And in this transaction, they do. We have 2 accounts. One gets the debit, one gets the credit. We're going to see that as a common theme here. In the next transaction, we are going to pay for a lawnmower, and that's going to be part of our supplies. We're going to put in the date is May 8th. We're going to put supplies here in the account title, and we bought this supply, this lawnmower, for $400. Supplies is an asset, and we know that assets go up by debit. So we increased our supply amount. Supplies go up by debits. Therefore, supplies gets a $400 in the debit column. We paid cash, right? So cash goes down, right? Supplies goes up, cash goes down. They're kind of both on this side of the equal sign. They're both assets. So in order to keep this whole equation equal, if one asset goes up, another one has to go down if we're talking about 2 assets here, which we are. So cash is going to go down. We're paying cash. We're paying $400. So cash goes down by $400 and supplies goes up by $400. This transaction is done And what we know from this is that we increased supplies and decreased cash. This next one is very similar. We paid cash for gas cans. Let's just say we did that the next day. Gas cans is a supply, and we paid $50 for it. You see how this is kind of working here? Same basic deal. Paid the cash, cash goes down by a credit. Cash went up in this first transaction by a debit because like we received cash. Whenever you're doing accounting and you see a list of transactions like you do over here on the left-hand side, take a look at the first word. Did we pay cash or did we receive cash? There are going to be some of these where cash isn't even involved, but when we paid cash and received cash, it kind of tells us if cash is going up or down. And we can kind of use that as a nice little hint as for what the journalization is going to look like. Again, this document is called an accounting journal. And just like your own diary that you might keep at home, it's going to list every single thing the business does in nice sequential order. And as I said, accounting is kind of a foreign language. So someone who doesn't know what any of this means, they don't know what debit or credit means, they wouldn't be able to understand this. They just see like, okay, I see numbers. What is this? But you know what it means. So you're kind of getting this foreign language. Let's do one more in this video, and then in the next video, we're just going to finish off doing the rest of these transactions, okay? So let's say the date is the 10th, May the 10th, and your friend is going to pay you for your bookkeeping accounting services. That is an expense unto the business, and it gets paid with cash. So cash goes down by what? It goes down by credit. It's an asset. Any asset goes down by credit. Okay, so we know cash is getting the credit, right? So then something else has to get the asset. Well, I kind of identified exactly what gets the debit here. And that would be expenses. Remember, we list expenses in as debits. So cash gets the credit, expenses gets the debit here. So I'm going to put in here basically paying you a wage for your work or salary. Put in wage expense here. And your cost is $25. And cash goes down by $25. Simple as that. So we have done 1, 2, 3, 4. 1, 2, 3, 4 transactions using this 2-column journal. In the next video, we're just going to run through the rest of these transactions here, and we'll kind of see how this plays out from start to finish. All right, go watch the next video when you're ready. Thank you.